Good morning, everyone, and welcome. And thank you very much for attending. I'm Chris Bennett. I'm MD and one of the co-founders of EVORA Global, a sustainability consultancy for real asset investment. And there's a scattered, actually far more in the room than I was anticipating, so that's really great to see. But I understand there's more than 250 online, so that's wonderful to be live streaming today. And I'm going to kick off with a short presentation, and then we'll move to a panel discussion with Paul Sutcliffe chairing, another co-founder from EVORA, and there'll be plenty of time, I'm not sure for everybody, but there'll be plenty of time for Q&A at the end. So today, and one thing I'd just like to add really is just to thank Finsbury Glover Herring as well, who've worked in partnership with us on this today. We've been running what we've termed an EVORA Insights programme for the last 12 months. And as it says, it's to gain insight into the market. And I think for us as consultants, getting that intimate understanding of our clients and of the market is absolutely fundamental to help enable us really share knowledge, experiences, and in what is the fastest moving evolution of ESG I think we've ever seen, help keep track of what needs to be done. And we've been looking at three key areas. We've been running some client lunch roundtables under Chatham House rules, but there are certain things that I can share that have been quite revealing. We've been doing interviews and surveys, and that especially in relation to technology. We have our own technology, Sierra, software platform for this industry, and just really sitting down with the stakeholders and looking where we believe the industry is evolving to and what the expectation is, and very much going from historic data and reporting to look at forward to scenario analysis to say how do we actually have the insight to make decisions going forward in such a changing world. And most pertinent for today is that we did an investor survey for real assets. It is predominantly real estate. It's termed real assets, but there may be a bit of infrastructure input. And really just to see how ESG is integrated into the investment life cycle and whether people believe they're leaders, laggards, and what that actually looks like. So we had 121 respondents, which was discrete companies, which is absolutely fantastic. I think for the industry, it's superb, representing about 2 trillion of assets, which is around about 10% of globally managed assets, very much European focused. And I'm going to share with you just some of the highlights. Forgive me for having my screen in front, only I've just got a bit more detail of the survey, certain things that I want to pick up on. So, interestingly, around about 1/5 of the 121 respondents were actually asset owners. And I think that's fantastic. It may seem a low number, but actually to get the investors involved in this and see that as really important, I think just recognises the importance that investors see in the ESG agenda. And we see that, and I think the investors managers would agree that they see the investors putting more and more pressure on them to treat this as a fiduciary duty and take this forward. Not surprisingly, the fund managers are high up there, and then sort of equal amounts between asset and ESG professionals. And probably not surprisingly, with 121 respondents, not all of them have their own leads in ESG. With regards to assets under management, almost half is more than 5 billion under management. And this is great to see, so it's got a really good representation and shows such an interest by those who have large portfolios. And about 3/4 more than 1 billion under management. And then geographically, as I said, this has been predominantly European focused. There is a bit of a mix. And as an organisation, EVORA is moving into North America and Asia next year. And as a consequence, we hope that we'll have a more global representation when we repeat this. But thank you to all those who have responded. So to kick off, really what I want to start off with was the impact on regulation. And what's really interesting here is that 100% of respondents said that regulation was really important to their decision making. And 55% said it was on more than one level. Notable that for the bigger players, That's in the sort of purple, dark blue. They see the fund and the corporate sides as more important. And I think that's really the emergence of things like TCFD and SFDR, the Sustainable Finance Regulatory Directive, that it's driving the portfolio importance into decision making. That doesn't mean that the asset level isn't important, and we can see across the board that is important. And I think actually that was highlighted back in July, both for British Land and Landsec. Their share price was hit by about 4%. And that was representative of the concerns over they're getting their buildings to an EPC-B rating by 2030 and the associated cost of doing so. I think also it's really important just when we start to think, about how the funds are representing themselves, and it was notable as well, just to highlight, DWS, not from a real asset perspective, but across the piece. Their share price was really hit in August, fell by 14% overnight after an SEC probe just on ESG claims that we were making over how sustainable their investments were. And their share price has not fully recovered, it's still 10% down. So the importance on regulation is fairly obvious, I feel. I think when we start to see, what's the impact overall on value, 93% of respondents said that value had a direct implication to the ESG agenda. That's a broad comment to make, but I think what's really interesting here is that when you look at all the different categorization, the lowest is 43%. And we're not in single digits, so everything is being taken really seriously now. Notable reputational risk comes right at the top. And I guess after we've seen some of the hits on share price, not that surprising. And I think there's going to be a lot of peer pressure. And I don't see that as an issue either. I think we're going to start to hopefully see some greater momentum, maybe a bit of an avalanche, and that transition and that concern over reputation, especially with the institutions, is going to be quite significant. I think on top of that, we start to see the impact and concern on leasing. And again, I think there's a recognition that from an occupier perspective, there will be a change in behaviour. And it was great. It's interesting, actually. It's a bit of a gold standard, but we were at CADWorks last night, where UK GBC was, and thank you to Basil at FOR for letting us be there. But a beautiful, sustainable building. But from talking to FOR, who own the building, it's when you look at the credentials, we're getting the highest rent, 15-year leases, and really high covenant strength from tenants. So there is a driver that way. And I think it was also notable as well, going slightly off-piste, but we were in here yesterday and Booking.com were talking about how do you get to net zero. And when you think of the disaggregation and the complexity of the hotel industry on a global basis, and I think apart from two things came up, one was the flow of capital, the flow of finance that needs to happen, which we're going to talk about today. But the second one was just behavioural change. And Booking.com was saying what they need and what they anticipate to see is that when people go online, they'll see a sustainable rating for a hotel. And that will quickly change behaviour, where people feel uncomfortable in staying at a hotel that's not sustainable. And I think exactly the same is going to happen with buildings, and we're going to quickly see that change. Interesting that still, financial issues slightly lower down, but still high. I think the cost of retrofit is going to be high on people's agenda, impact on cash flows. When we look at the overall impact on how ESG is actually integrated into investment firms, some interesting criteria was evaluated here. And again, the percentage is really high. I mean, 85% said they use ESG for investment decision making. That's fantastic to see. 75% they were training their investment professionals in ESG. Also really notable that they said 40% had ESG representatives on the investment committee, on the investment decision making, and they had voting rights. Now, I said we had Chatham House rules, but one notable thing in one of our round tables that we heard was that there was very rarely a red line for any ESG event. So for regulation, yes. For going over budget, yes. But again, we have to be realistic here. I guess there has to be application of capital. Product can be sometimes difficult to get hold of, and it can be very competitive. So it's going to be interesting to see, are we going to see an evolution that rapidly changes that, where ESG decision making in the IC is going to have a major implication. The final point, which isn't here, which is fascinating, I've got on screen, 41% of investors said they were market leading in ESG. Indeed, a few titters from the audience there, hopefully online as well. Didn't specify what they meant by that. I'm going to come back to it. ESG data. You cannot have any presentation without data. And data is messy, as is this slide, so I think that's helpful. But what are we looking at here? I think interesting that probably the biggest challenge in the industry is to get good, complete data. And it's notable still that, you know, the biggest survey and submission assessment that's done, which is GRESB, the majority of the points still reflect coverage of data. Not necessarily quality, but certainly coverage. And it is still a challenge within the industry to get data. I think notable points, 97% of energy data is being collected, apparently. That's what the view was. But of that, 85% of the respondents said they didn't trust the data. Which I think is, you know, it's scary, but it's something we must take into account. Because if we're saying that investment decision making is being aligned with ESG data and it's not trusted, where does that take us? And I think the other point to note here is that to drive the quality, we need automation coming directly from the utility suppliers. And at the moment, only 5% is automated. When we start to look at integration into the ESG life cycle, again, really high percentages. So fantastic to see just the engagement by all of the respondents here, and especially for investment decision making, and also the operational ownership, the management of the buildings. But I guess, is this really reflecting the capital allocations going into ESG and the impact that we're seeing? Something, again, that we can put to the panel later. Finally, from the point of view of what is really important, it was notable, again, that rather than a green building or investing in the green buildings, the most number one priority was where to invest. And the impact clearly that people see of climate change, extreme weather conditions, social economic impact as to the first point, geographically, where should we invest going forward? Other points you can see which were important was the sustainable property management, the operational management to make sure that it's appropriate for the occupiers. But notable, the number one is location. Finally, with regards to what is being reported on, as I said, I think, you know, GRESB has been certainly a force for momentum for change, and it's been going for 12 years now and has really driven the industry to make good progress. And I think everyone would agree that from the investor's perspective, they see this as a representation of performance. I think we have to be realistic and actually say, you know, this is more about the controls and systems that are put in place at a management level, and probably more about coverage of data than for performance. And there are other reporting standards coming up, and I think, you know, SFDR, the initiative that came out in March, is going to be starting to look far more at how funds are positioning themselves and defining with transparency how sustainable they are. And I think the Task Force for Financial Disclosure on Climate Issues, the TCFD, again, is going to be a force for change as well when we have to start having that transparency. So I've summarised all of this into, which I think is quite a fascinating slide. So out of 121 respondents, 2 trillion of assets, predominantly Europe, as I said, we are looking at, I'll just pull up I've got broader stats here actually, which is interesting to look at, but 75% say they use ESG data for decision making. 41% think they are market leaders. 87% integrating ESG into investment decision making. 74% say it's going into operational management. 40% saying there's representation on the investment committees. But I guess, contrary to using that data, only 5% of data is automated and 85% are concerned about quality. But notwithstanding that, these are high percentages. So I want to challenge the audience, the panel, to say, what does this actually mean? This seems to be a force for good. You know, so much emphasis compared to a few years ago. These aren't single digits, you know, these 70, 80% saying that ESG is being taken incredibly seriously in the whole investment life cycle and investment decision making. So if that is the case, does that mean we've got nothing to worry about? You know, actually, our profile to net zero is set. It's going to be, well, forget 2050, maybe 2030. Does it mean we've already adapted ourselves to climate change? Our buildings are already resilient? Or are we delusional here? Or is this more about where the mindset is that this is serious and there's an evolution that still needs to happen to turn that good intent into action and capital flows? So I'm going to leave it there. I'm going to pass over to Paul to lead the panel and maybe raise some of these interesting statistics that we've had here to see what that actually means from the point of action that's being taken by the industry. Thank you very much.
Thank you, Chris. Thank you very much. I'd like to invite the panel members up onto the stage, please. Please take a seat. So we have Peter Epping, who is Global Head of ESG at Heinz. Yes, sit wherever you want. We have Bill Hughes, Head of Real Assets for Legal and General Investment Management. We have Nina Reid, Head of Responsible Investment for Property Management globally for M&G. And we have Emma Palmer, Head of Responsible Investing at ICG. So, hi. And of course, not to forget Emily Mazzicarati. I hope I've got that right, Emily. Emily is online and will be participating via Zoom. So we have a true hybrid event here. So we're here today to discuss, I'd like to discuss opportunities and risks and build on some of the points that Chris has raised in the introductory session. But before we get stuck into that, I think we've come all the way to Glasgow. We're at an event. It's fantastic that you're here representing your organisations. I think it would be remiss of me not to give you the opportunity to introduce yourselves and tell us a bit about where you are on your sustainability journeys. So I'd like to start with Peter, please. So, Peter, over to you.
Thank you very much, Paul. I'm Peter Epping, Global Head of ESG for Heinz, and happy to represent a firm that has a long history as a family-owned company, 70 years in operation, active in 255 cities across Europe, Asia, and the Americas. And while initially Heinz was really a development firm when it was founded, today Heinz is still a developer, but also a fully fledged real estate investment manager with over $80 billion of assets under management. The current discussion is very interesting for us in many ways because we were founded by a mechanical engineer who had a huge obsession, not just for aspirational architecture, but also for building efficiency and customer experience. And he focused on quality and durability of the buildings over the decades, worked with very good architects. And that kind of whole thinking, that mindset, was later then called sustainability and really inspired generations of project managers in our firm really to innovate and to go for building better buildings for the tenants, but also really being very conscious of the place of buildings in the cities over the long term. what has changed over the last 12 to 24 months, I would say, is that this constant drive that we had and other firms had as well has really been pressure tested by the global problems we're facing. And it's become so unmistakably clear that we just need to speed up, and we need to become a lot more organized, even in an industry that's inherently local and a bit more dispersed. And for us, that was really the reason to drive a year-long effort with a large working group from around the world in our firm, with consultants, including, of course, the very good team of EVORA, and come up with a global strategy that is trying really to consolidate what we do in 27 countries and share best practices in a much more effective, much more data-driven way to really reach much more ambitious targets.
So we'll come back to this, but the key takeaways there, data-driven way. So going back to Chris's point. Emer.
Thanks, Paul. So my name is Emer Palmer. I'm Head of Responsible Investing at ICG. ICG is an alternative asset manager, so we invest across the capital spectrum, and we have 4 business lines: structured and private equity, direct lending, credit, and also real assets. Real assets is about 10% of our AUM, and as a firm we have about over $60 billion in AUM. But real assets has been a real focus for us in terms of sustainable investing, because we see this is where there's real opportunity to really innovate. And so we have 3 sustainably themed funds within that asset class. So we have a green generalist infrastructure equity fund, we have a real estate debt fund, and we also have a sell and leaseback fund. And a big focus in the past recent months has been on developing green loan frameworks. So one of those funds, the real estate debt fund, we've worked very closely with EVORA to develop our green loan framework. And we're also in the process of rolling out 2 more as well across a couple of the other real estate strategies. So we feel this is a very exciting time. We can be very innovative. From a global ICG perspective, the biggest and most exciting news that we have so far is that we signed up to net zero just last week. So we were one of a very small group of alternative asset managers to commit to net zero. We committed to that by 2040. And we've also had an approved and validated science-based target this week as well. So one of the first in our industry too. So
fantastic. Thank you.
Thank you.
Thank you. Bill.
Yeah, thank you. Bill Hughes. I'm head of real assets at Legal and General Investment Management. So we're a global fund manager, 1.3 trillion sterling under management, and the real assets business I'm responsible for that is investing in real estate and infrastructure is around about 37 billion of assets under management. So we're reasonably significant by size. I think when it comes to transition to net zero, I would say we've been working hard on that for around about 15 years. So I'm excited to be at COP26, but I don't think of it as being the moment. I think it's a sequence of events that are taking place over a period of time. And I'm, on the one hand, optimistic that in the agenda that is in front of us from our investors and the agenda that is in the boardroom in our organisation, sustainability, decarbonisation, considerations of long-term sustainability are very much top of the list. But I suppose I'm also realistic. It feels to me that there is a huge amount still to do. And to the comment made earlier on, I have no sense at all that we've arrived with regard to this subject. We're working tirelessly to make sense of this. We're seeking to use our influence in the sense that we're actively engaging with investors, with governments, with policy decision makers. We are actively engaging with consequences wherever we can. Mm-hmm. And this is something that we feel passionately about. Really interested in hearing how others feel about this, but I'm right between optimistic and realistic.
Thank you, Bill. Thank you. Nina.
Hi, Nina Reid. I'm head of responsible investment at M&G Real Estate. We are part of M&G PLC, which has got about 350 billion assets under management, covering equities, fixed income, and then private and alternative assets in which real estate sits. We have about 35 billion assets under management worldwide, and my role covers integrating ESG and responsible investment into all of our fund and investment decision making. I think probably following Bill, fairly similar journey. So, you know, we've had a long-standing commitment to responsible investment, ESG. Definitely, as probably many in this room and online have found that a real acceleration of that over the past 18 months, and it's been really exciting as a sustainability professional to see that, you know, this really come to the fore and there be an energy and commitment around it that we haven't really seen before. Similarly, I share the kind of optimism and realism that I think, you know, even organisations such as ours that have got a really strong commitment and trying to embed this, we are still fairly early steps on that journey to what net zero means. And as an industry, we are going to have to see some really radical changes about how we think about buildings, how we manage buildings, how we develop buildings, and we're nowhere near that. And it will require, you know, collaboration, sharing of how we get there. We need much greater kind of tools and simplification around some of this because it's very, very complicated at the moment. You're taking a lot of people on a journey and we don't really have the tools or the language to sort of bridge that, and we need to get there very, very quickly. So it's exciting, but we also need to mobilise kind of consolidated effort to get there.
Thank you, Nina. And last but absolutely not least, Emily, by the power of Zoom, would you like to introduce yourself and your organisation?
Sure. Good morning, and thanks for having me over Zoom. My name is Emily Mazzacurati. I'm the Global Head of Climate Solutions for Moody's. Moody's is a global risk assessment firm, and in that capacity, we're an enabler of the shift to sustainable and resilient markets. You may, of course, know Moody's as the credit ratings agency. That's a large part of our activities. This is not where I sit, and I do not represent the ratings agency. I sit in a group called Moody's ESG Solutions that was founded 2 years ago following the acquisition of 427, the firm I had founded, and another ESG ratings firm called Vigeo Eiris, known as VE as well. And what we're doing is we've pulled together those capabilities on climate, environmental, social, governance risk across a range of asset classes. And we're here to support our clients, but also support the integration of climate and ESG consideration into credit risk ratings, into all the analytical models and credit risk models, macroeconomic forecast, decision support platforms that Moody's Analytics provides to the market in the banking, insurance, real estate industry. Maybe a few words about 427, since this is how I came to be here. I founded the firm back in 2012 to support the integration of climate risk into financial decision and to support henceforth the investments in adaptation and resilience. And so we are very focused historically on the physical impacts of climate change and thinking about how to best understand and measure and quantify those so that we can help make the case for more investments in adaptation and ways to manage those growing risks. So very much looking forward to the discussion on that. And then for my view on COP, also a mix of hopeful and jaded, I guess. Maybe I've been doing this a little too long, but what I'm really hopeful about is I see the private sector almost ahead as a number of governments at this point, and ahead in terms of the growing consensus from a large number of very powerful, influential institutions, financial institutions, that this really matters and that we need to get to net zero. And so now we need to deliver, and that's going to be the big question.
Okay, thank you, Emily. And I'm going to stay with you. And the first question I'm going to ask and open up to the panel is around awareness and understanding. So we've heard a lot about the challenges from Nina, the complexity, and so Emily, as a supplier of physical climate risk solutions to the sector, how would you say understanding of what physical risk means is like out there? Is there a gap in understanding? Are there any common misconceptions? And are there geographic variations? So do you see a better understanding in some locations than others? And could we perhaps learn as an industry?
Sure. So maybe I'll start with the last part of your question, which is the geographic variations in use and experience. And I will say, oddly enough, maybe because the US is not typically front runner when it comes to climate, we have seen a fast take-up rate of physical risk assessments in the US because this is where the risk is experienced firsthand in terms of the increase in extreme weather events, floods, hurricanes, wildfires that have had direct impacts on real estate and a number of other industries. In Europe, it's more of an emerging topic, but of course, Europe has had its share of windstorms and floods recently that are starting to shift mentalities towards, oh, this also matters. And in APAC, there's a long-standing tradition of being exposed to a lot of extreme weather events, very strong building codes in markets where the real estate is maybe part of those global markets. So more nascent interest in understanding how those risks are going to shift. And so that's the second part of my answer is we've come a really long way and we have a really good understanding of current and future risks at this time. So starting with the climate component, right, using global climate models, we have a very good understanding of how the physical conditions in which we operate are going to change over the coming decades. And that includes in particular, chronic changes around temperature, water stress, but also increased precipitation that can drive floods, increased in the drivers that cause hurricanes or wildfires. And the protections are quite narrow in terms of the range when you look 10, 20 years out, because there's a lot of impacts that are locked in. And then the protections range get really wide when you look further out. And this is where scenario analysis becomes really important, especially for risks like sea level rise. Now, we also have CAT models, catastrophe models that provide a very detailed probabilistic view of weather-related natural disasters, like hurricanes, floods, winter storms, wildfires, current risk. What is the probability that this type of storm will hit this location tomorrow or next year? And those models were also growing to evolve the probabilities over time by integrating climate data so that we're able to say today's probability of hurricane is X, but over time it might grow to Y and Z because of the influence of climate change. And then we take these and we look at the impact on market trends. So we just recently released a report looking at the correlation and potential influence of flood and sea level rise exposure on construction trends in Florida. We look at the impact on credit risk for mortgages in particular. So looking at the impacts of recent extreme weather event on key markets in New York, Los Angeles, Houston. We looked at how metrics like rent, vacancy, NOI took a dip after a big flood or a big storm, how quickly they recovered or not. And then we take that and we build scenarios around what if or what when those events become more frequent, more intense, back to each other, how will that affect long-term market trends and of course credit worthiness of the mortgages. And then the work is really to integrate those metrics and sort of bring them to our customers into the various platforms so that we can help and support the integration of climate risk into decision making.
So I can see there's a clear requirement. You know, as an industry, we've got to take physical climate risk seriously. Do you think the awareness is there yet? Do you have any challenges in explaining your process to the market, to the industry?
This is where we've come a long way. There's when I founded for 27, and I was having those conversations in 2013, 2014, would get a lot of blank stares. I would get a lot of like, this is for 20 years down the road. Don't need to care about this right now. And then Mark Carney came in and the TCFD and Paris alignment and the science, right? Unrelenting releases of reports showing how bad things are going to get if we don't act, and we're not acting fast enough. So at this time, no, it's been several years now that the phone is ringing, and that we have a strong understanding from maybe I would say the sort of the top tier of the market. I think there's still maybe some deeper tiers in the market, smaller groups that may not have that understanding or the resources to engage with those questions yet, but we're seeing that becoming more and more widespread.
Okay, thank you. So on to Ema. Ema, from your experience as a debt and a lender. And you highlighted earlier that you've moved to issue a series of sustainability-linked and green loans. What do you see your biggest challenges are, specifically around awareness?
I think it's really around, we spend a lot of time sort of engaging with the borrower to explain to them about our green loan and how it works. And I think there's often a reticence, because I think borrowers like to know exactly their financing costs and like to have that fixed. And the way our green loan operates is that they make a commitment. So they commit to achieve a certain target. And so we spent a lot of time developing this. It's essentially a scoring system in our flagship partnership capital debt fund, where if a borrower achieves a certain score, then they qualify for a high ambition loan, and really that scoring and the high ambition is dependent around energy efficiency, so achieving a certain energy efficiency target, and then there's also a medium ambition, and it's engaging with them so that they understand, I guess, the process and how we look at it. I mean, we are heavily incentivized ourselves to issue these green loans. We've even got a line of credit linked to that fund, and the line of credit is linked to the amount of green loans that we issue. So we really see this as a big opportunity for us, and also for us as lenders, it's the way we can really influence. I mean, it's really the key leverage that we have. Yeah. And so we issue green loans and we provide a margin discount on the loan. And I think a lot of it has been around what is the right level of the margin discount in order to properly incentivize people and ensure that they can actually deliver on the commitments that they're making, and that it's achievable. And so because we invest in the private market as well, and it's in the mid-market, it's been finding that sort of level, because we're not investing in premium central London real estate where that's very well established building certifications. We're investing in sort of in the more regional areas of the UK and especially in Europe as well. And so it's finding that sort of the thresholds really. What are the thresholds that the market can tolerate? What makes sense for our borrowers as well? So it's been a lot of engagement with them, even in the development of our framework, to make sure that we've got it at the right level, and then following that to encourage them to actually commit.
So I guess from an early stage, you identified that if you created this in isolation and took it to the market without the engagement with the borrowers, it wouldn't get very far.
Exactly.
So there has to be communication and understanding throughout that process. Peter, Bill, Nina, I'm keen to invite your views on general awareness. And do you see a challenge in the industry in terms of it's a big complex topic. We've talked about two key issues: green loans, physical climate risk just now. Do you see issues around awareness and around understanding, and what can we do to address this? Little question there. So Peter, would you like to go first, and then I'll open it up and
I think there's no shortage of awareness in general. I mean, the topic is inescapable every day. It's in the papers, on TV, everywhere. Everyone is acutely aware. But I think what the flip side is of all that information and publicity in a way is that some people are glazing over or are overwhelmed with the amount of information that's there to process. And when we look at the spectrum of our clients, we have some that are very sophisticated, but the majority is really starting on that journey, and is really trying to think very hard about how do we even start to systematically go through a very large portfolio that's spread out across the world. And what we're hearing is that they're finding it difficult to access the skills and the consultants, the infrastructure really to do this as quickly as many of them would like to. So it's a lot. The question is very much about the how.
Yeah. Okay. Bill.
I think I probably want to talk about two things.
Yeah.
One is investor behaviour, and the other is timeframes. So one, investor behaviour, and I would agree with the general comment that awareness is high. It's unequivocally the case for us that almost every single investor, or even groups of investors coming from the retail side and private investors, are putting this issue high on the agenda. Yeah. Now, I think it's there, but one thing that we're thinking hard about and have done for many years is making the connection between carbon transition and sustainability and the investment returns that we deliver. and this gets me to time frame. If you think about time frames, if you think about long term, okay, given the climate risk and the destruction of assets and the flooding and the weather and the behaviour of regulators, it's obviously the case that you have to put this issue very much into your thinking when you're thinking about risk and return. For a long-term investor, that's relatively easy. And by the way, if I'm thinking about now in 2021 versus where we were thinking about this in the 2007, the issue is looming larger and the timeframes feel shorter.
Mm-hmm. Yeah.
So I don't think it's difficult to really prioritise this now compared to 15 years ago. And I think the logic and the investor behaviour is absolutely taking us all in that direction, simply because you have to think about that to ensure that you're preserving the value of assets that you're investing in. And some people call it future-proofing. We've got lots to do, don't get me wrong, but I do think it's necessarily front and centre for investors. Investor behaviour is all over this, and as a fund manager, we have to treat that as being a first-order issue now, in the way that 15 years ago it was probably a little bit marginal or a bit optional, or we were a little bit wild and crazy then, probably, in the eyes of some.
Yeah. I think my practical experience is that the buy-in, the acceptance, the understanding, certainly at the investor level and the fund manager level, is there, and there's a recognition that we have to do something, and an acceptance, an absolute acceptance with the clients, the broad range of clients that we talk to, that there has to be progress. I think the challenge comes, and this is what we're hearing from COP as well, the challenge comes with action. And to make action, it's engagement of whole supply chains, of partners in a very complex topic. So I think, Nina, any views on that? And
I mean, kind of would definitely echo what's come before. And, I think our strongest push over the past 18 months has definitely come from investors, really asking very demanding questions, either due to their own commitments or where they see kind of regulation going. I think what we've struggled with is our the upskilling, as you've mentioned, of the supply chain to deliver that. I mean, net zero building audits, for example. So everyone wants to understand net zero, but there's still a massive skills gap in the industry about what is a net zero building audit. And that's in the UK. When we start to think of portfolios in Asia, at the moment, it's almost impossible to access those types of audits in a lot of countries, probably not Australia, but, Japan, Korea. You've got language gaps as well. The tools that have been developed in Europe, let's say CREM, for example, that haven't really penetrated into kind of the market thinking, and it will happen, but not at the rate that our investors are kind of expecting us to respond to that. So I think there is a really significant skills gap, kind of people that have relied on very small sustainability teams. That is not going to be the model that scales. It has to be everyone's responsibility. And we are seeing really big upskilling within the supply chain, but at the moment I think there is a kind of misalignment in that. And I guess I've kind of made the point earlier, but I think one of the challenges is at the moment we're trying to upskill people about physical risk modelling and what that means. We're trying to upskill people about net zero and what that means. We're trying to upskill people about TCFD, SFDR, taxonomy. And I can see why people feel a bit overwhelmed at the moment, because it's quite complicated. It's not very interlinked. It's not simple. It's not easy to make decisions off basically quite individual topics. And I think very rapidly the industry could help itself if we tried to create a bit more simplification and standardization in some of these, at least to get us to the next step. And probably won't be perfect, but I think it would be a bit of an improvement as to where we're at the moment.
Thank you. So if we take one of those examples, TCFD, Task Force on Climate-Related Financial Disclosure, it's becoming increasingly important. It's been mentioned several times already. I don't want to get into the weeds with this. It's quite a detailed topic, but if we're thinking about physical climate risk, transition risk, and how that's mapped across a business and understood, I'd be keen to know from the panelists where you are with TCFD, what's been considered, and what you see the biggest challenges are, especially when it comes to, it's in the title really, climate-related financial disclosures. So it's about linking climate and finance. So Peter, I'd like to ask that question to you first.
Yeah, I think fundamentally I have high hopes that TCFD actually will be one of the catalysts that helps integrate the focus on net zero into the economic equation, because that's what's missing at the moment, especially as Bill was suggesting, for shorter term investment strategies where you don't know how much value or risk avoidance does your additional investment really yield. But for us, the way we look at it is we take our flagship funds, and that's where we implement these kind of things first. And we've actually used 427 as a model, very happy with that. And it's just what you learn is just makes it so obvious and easy to grasp, and the transparency for a whole portfolio of 30, 40 buildings is something that allows you to be systematic, to explain to your investors how big the risk is. It can be reassuring, but it can also be eye-opening when you realize that some of your assets may be stranded actually by 2035, whatever the date.
So can I jump in there?
Yeah.
What are you going to do about those stranded assets? Have you got a plan yet?
Well, this was
That's
actually...
putting you on the spot, but really...
Yeah, that's all right. This was actually a reference to a deal we were looking at, not in one of our funds, but it was outside, and was the first time we were looking at a large office transaction in Germany, and there the result was that it would have been stranded by 2036 unless the grid is 100% renewable. And it was a big question, because the problem was that at this stage the group of consultants were not yet in a position to exactly specify how the upgrades would work, what the overall cost picture would be. So what you mentioned, the quest, the challenge of upskilling was very tangible in that moment, and it made the whole conversation about the acquisition, which was a sizable one, much more complicated. And for me, that was the first time I was actually close to a transaction where it led to this not going ahead, it was not the reason that it would be stranded. There were other reasons, but certainly it made the whole situation
it had an impact.
More unclear. Yeah.
Okay. I think, Emma, from your perspective and ICG, have you considered TCFD and moved forward with that as an agenda item?
Yes. So we use the TCFD framework really to guide our entire climate strategy, and we've been reporting against the TCFD since 2019. We're also a listed asset manager, so it will become mandatory for us very shortly. And we're also looking now at the TCFD requirements and how they will apply at fund level, so we can start to implement those in advance. But yeah, we've done a lot around it. In the early days, we did a gap analysis of our entire kind of how we operate really, and sort of looked at our kind of governance framework, and made sure that we appointed an NED on the board responsible for ESG. And also we've developed a climate risk assessment tool which we embed into our ESG screening checklist. So we look at climate risk as so every single deal that goes to investment committee essentially gets a climate risk score, and it's focused quite heavily on our corporates at the moment, but we're building that out more and more for real estate. And so it's low, medium, high, or very high. And then if you score kind of high or very high, then you're required to do kind of additional questions during the due diligence stage. But it's very transparent to the investment committee members where the risks lie. So that's been a really key tool for us. We've also expanded our exclusion list. So exclusion list now excludes investments in coal, oil and gas, where it's more than majority of the revenue from any of those. So it's quite an extensive exclusion list, and I guess it lends to our whole sort of pathway towards net zero and decarbonisation of our portfolios.
Okay, thank you. Bill, Nina, are you aware of, well, obviously aware of TCFD, but are you aware of any taking on from Peter's comment about deals that have gone through or fallen through because of physical climate risk or transition climate risk? Is that something that is increasing? You're seeing happen more?
I mean, I think we've definitely kind of had long-standing kind of, we won't invest in assets that are in very, very high flood risk areas. But I think properly integrating long-term physical climate risks, we're probably relatively early days in, excluding deals because of that, but obviously sort of thinking about that more. I think one of the interesting things about TCFD, and obviously we're thinking about both transition and physical risk, we've looked corporately and real estate specifically, a lot of the physical climate risk models at the moment. I think the interesting thing is obviously the investors are pushing that agenda at the moment about physical climate risk, but I think there is still a bit of a so what question. Like, what are investors actually going to do with that information? If you use 247 to do your analysis, 427 to do your analysis, and we use someone else, and those climate VARs are at the moment very different between different providers, how do investors make sense of what that kind of risk actually is? And, you know, in the same that we organisationally, big organisations have a lot of resource to look at that information, smaller investors won't have the resource to sort of interrogate or understand that at the moment. And we've started to have discussion with some of our larger investors about, okay, what does that mean in terms of risk tolerance? What level of risk is acceptable for you on a portfolio level? Because that's the bit that has to influence the acquisition decision making. You know, if you're going to invest in many parts of Asia in particular, we don't do as much in the US, but the same would be true there, you're invariably going to have a much higher climate risk in Asia than you are in parts of Europe. Does that mean someone who's a global diversified investor wants to not be in Asia because of the physical climate risk? Probably not at the moment. So therefore, what level of portfolio risk do we need? And then that should influence whether or not we do deals, probably at a portfolio level rather than an asset-specific level. The other thing we found at the moment is a lot of the tools don't necessarily allow us to feed back the impact resilience measures at a building into the climate VAR models. And again, that's something we think needs to develop a bit, particularly for kind of TCFD reporting. So I think at the moment, it's quite hard to use that as a sort of go or no go on decision making, but it is kind of inputting as part of that. And clearly if it was a really, really high risk, then no. But if it's a high risk in 2060, I think that becomes a bit more difficult at the moment to say whether you should proceed or not with those deals. But that's definitely where it's going, and probably, you know, we'll see over the next 2 to 3 years increased sophistication around that and conversations with our investors, but it's probably not there quite yet.
I think for us things have so I mean that we're not that different, but I think for us I would say things have really changed in the last year or two, okay, because aside from physical risks around climate change, I think this much bigger focus on transition to net zero changes the game a lot. Yeah. So, you know, variously around this table, there'll be people making commitments to 2030 or 2040 or 2050 in various ways. And we published a pathway to net zero. I'm sure EVORA would have been involved back end of 2020. Yeah. And that changes the mindset. So there are assets that we simply don't believe we can own and get to net zero 2030, which means that we wouldn't buy those assets. It means if we're owning them already, we've got to be thoughtful and creative and make a judgment about where's technology going. Yeah. Will we get enough roadway and assistance in making those assets work for us or not? And this thing about stranded assets, by the way, I mean, this isn't a game where there's an asset that gets stranded and it's left all on its own and that's a merry-go-round. The real world we're in is some assets are going to accelerate in terms of depreciation and obsolescence relatively quickly now. And the goal of everyone around this table, I'm sure, is we don't want to be in the assets that end up in that place. But there will be a lot of owners of assets that end up in a place which is unusable. So when I think about our investment committee now, it's focused on how do we actually manage this asset to net zero is really front and centre. And again, 2 years ago it wouldn't have been. 2 years ago we were thinking about flood risk more. Yeah. And so I think that's a game changer. This race to zero, transition to net zero. I think carbon's not the only thing that matters, but boy, that does change our behaviour. Yeah.
I think for one of my recent experiences, we supported due diligence on a real estate asset. It was in Germany again, and we looked at in looking at the building, there were a number of risks. So there was a high stranding risk, a lot of initiatives that needed to be addressed, And as a result of that, the client that was working for, wasn't any of you, adjusted the price offering. But the market is not moving at the same pace. So others did not. And the building, which was still from a financial perspective, it was attractive to the client. They lost out on that deal because they'd incorporated costs in to address net zero. So they, on the one hand, they'll be saying that, okay, we're happy we didn't progress with that deal because it didn't go through because climate, we needed to address climate risk. But also, you've got a large proportion of the market that is not with you yet. They're not moving forward, and so we have a number of front runners that are progressing net zero carbon, that are progressing. And what I think is really important, I'm keen to get your views on, is how do we bring that long tail of real estate operators, whether it's private equity or otherwise, into this agenda to address and understand this, because as an industry, that's what we need to happen.
Yeah, there's going to be winners and losers, aren't there?
Yeah.
And probably you've got in the room here people who are relatively enlightened, are worrying more about the people who didn't come here today or haven't called in, and there will be winners and losers, and in a sense, the losers will dwindle and the winners will attract more capital, and they will be the players of the future. And again, I think the time frame is important here. Investors who think longer term have already got to think about this. Investors that think shorter term may end up with some adverse surprises. Absolutely. They may end up with assets they thought were liquid that are no longer liquid, for example.
Yes, yeah, clear. Emily, I'm going to come back to you. I think I'm keen to get your views on this, and also Moody's and your climate solutions are known for physical climate risk. But from a TCFD perspective, we need to consider not just physical climate risk, but also transition climate risk. So can you please just elaborate on this, elaborate what your views on where the market is and what you're doing to take things forward?
Sure, and I'd love to react to a few things. Great discussion. One, the last point that was made about the implication of the information asymmetry on the market and the fact that some folks just are not looking at this. From a cynical, profit-driven standpoint, there's a lot of good deals to be made, and your clients may maybe have a little bit of heartburn about having missed on that deal, but in the end, they're probably going to come out ahead. Now, the problem is from a what we need to do standpoint and saving the planet standpoint, we need to bring everyone on board onto those considerations. And this is why mainstreaming is so important. It just needs to be embedded into the tools that people already use for decision making, so they don't need to think more and add things from different bits and purposes. And to Nina's point, right now there's a wide range of how this is modeled on the market. And it's normal. I would be concerned if you compare the outputs from different providers from an exposure standpoint to physical risk and found very different risk profiles. That would concern me. The fact that the value at risk or the financial modeling of what that means are different, I think, is to be expected because it's still a nascent discipline. And I can tell you, for example, that the next iteration of financial modeling that we're going to do is going to be informed not just about what we've done so far, but also the recent acquisition of RMS, which brings, as part of the CAT models, a view of the expected loss and how much is insured. And so it's going to be a different number because it's going to be much more sophisticated. And there's also a lot of secondary impacts that are really hard to model, impacts of migration, impacts of changes in industry trends in certain regions because of chronic impact. So this is very complicated, and you're absolutely right to compare and to use it as input rather than as a final answer in terms of decisions. And now to your question about transition risk, yes, of course. We're investing in building out our net zero capabilities right now for all sectors, but CRE specifically is what I'm most excited about probably. We're working with a partner who has a great model and platform to support investors, lenders, developers in understanding at a very granular level their options for building retrofit to meet internal, external targets, local compliance requirements, net zero pathways. And so going back to the challenges that Peter was mentioning earlier on, we just didn't have a path for how to get this building or how much it was going to cost to get it to net zero. This is a platform that allows users to optimize against various requirements with a very detailed catalog of retrofit options, looking at technology selection, payback period, emission pathways, you get cost, and you get a very concrete path forward, right? So there's the two sides of the coins, both what are the risks, how much is it going to cost, how much is it going to cost to not do anything, and opportunities as an investor, as a lender, can I help make this happen? As a building owner, can I be ahead of the game? And so really trying to help make the transition to net zero concrete. And that's going to be important to not only to complement the physical risk offering that we have, but to feed into our mortgage models, our platforms, and to support partners like EVORA so that we all continue to enhance how we help the market with this transition.
Okay, thank you, Emily. So we talked about TCFD. I want to kind of expand that a little bit more and consider the role that regulation has to play in moving the agenda forward. So over the last 12 months, we've seen the EU taxonomy or take up and consideration of the EU taxonomy really come to the fore, and SFDR as well since March, the Sustainable Finance Disclosure Regulations. So I'll come to you first, Ema. So you talk about green loan frameworks. Is SFDR on your radar? Is it important to you? So how do you progress? How do you align that with the work that you're doing with the funds?
Yes, sure. So SFDR is hugely important to us. So as you know, it sort of came into effect in March of this year. And so we spent a lot of time before that sort of assessing all of our funds in the market to see how we should report them in terms of SFDR and how we should market them essentially, because all funds in the market as of March needed to be classified in terms of SFDR, in terms of whether they're Article 6, Article 8 or Article 9. So Article 6 is that they take into account sustainability risk in the fund, Article 8 being that the fund promotes environmental or social criteria, and Article 9 being that the fund has a sustainable objective, so it's essentially an impact fund. So the majority of our funds, almost all of our funds in the market were Article 8, and that's because of the screening process that we have around both ESG and around climate. But from a real estate perspective, actually we found the regulation to be really helpful. It's helpful in that we don't think it's complete or it goes far enough. I think it could certainly do a lot more. But at least there are very prescriptive requirements in order to be considered sustainable from either real estate development or refurbishment. You have a taxonomy which actually tells you what those definitions are, and that's really the first time in our industry we've had a sort of a classification system like that. And that is really, we believe that's sort of groundbreaking. It could certainly do more. So if you look at the requirements, so for example, for sustainable real estate development, you need to be 10% above primary or below sort of improvement on primary energy demand for new buildings. Clearly in our green loan frameworks, we want our borrowers to do more, and so we require that. But at least it's a starting point. So that there is a clear ambition, and the taxonomy will evolve as well. So we've only got part of the taxonomy at the moment. We haven't. The rest of it's quite a lot of it's in draft, and obviously a social taxonomy will follow. But for the moment, we have climate change adaptation and climate change mitigation, and obviously with the built environment being such an enormous contributor to emissions, at least having those clear definitions is quite helpful. For refurbishment, it says if you have a 30% improvement in terms of primary energy demand versus pre-improvement, you're considered to be sustainable as well. But you also have to do no significant harm to any of the other environmental objectives of the taxonomy, and there's 5 other environmental objectives. So it's a useful benchmark for us, and so when we actually bring funds to the market, we can assess ourselves against it. But clearly we want to do more, and we want our ambition to be higher, and so that's what we've been doing. I think a key thing as well that from our perspective that's missing is it's very focused on operational energy. And it doesn't take into account whole life carbon, so it's entirely silent on embodied carbon. And so in the new framework we're developing, we're actually looking at what thresholds we should set for the borrowers in terms of embodied carbon for the UK residential market. And so we're looking at setting a high ambition and a medium ambition, and we're at the process now of, as I mentioned earlier, engaging with our sort of borrower community to see sort of where the ambition level should be and what's achievable.
So the take homes I got from that is the taxonomy is really helpful because it creates that definition system. But to put it bluntly, in some cases it doesn't go far enough.
Exactly.
So open to the panel in terms of considering your funds and positioning of your funds. and perhaps Peter and Nina, keen to get your views first, and then Bill, I'll come to you. But have you considered Article 8 as effectively an entry level for your funds? Is that where you want to be, or have you got funds that are positioned at Article 6, which is for want of a better word, the bottom rung of the SFDR ladder? Nina.
So for our real estate funds that are caught by SFDR, all of them have been classified as 8 because we've kind of already got ESG targets at a fund level kind of predating the SFDR. So actually that was quite an easy kind of tick for us to do. I think across M&G there's obviously been a huge focus on the funds that went in as 6 to reclassify them as 8, and I think that's just a general industry trend that we're seeing at the moment, that it isn't going to be very long that people want to be in that 6 bucket for. We don't have anything as 9 at the moment, and I think 9 is quite an interesting classification in terms of real estate and understanding it. There's obviously some funds that will sit in that, but I think one of the things that both the taxonomy and SFDR don't cope with very well at the moment is transition instruments. They weren't really designed for real assets where you buy something and you're going to improve it over a sort of period of years. A lot of the regulation is set that either it's sustainable now or it's not. And clearly we all know that it doesn't really work like that in the built environment. So I think transition is one of the areas where we definitely also think that there should be kind of improvement. Agree totally with you that I think it's providing a very useful kind of backstop. It's definitely starting the conversation. It's definitely driving investor interest. But we will also definitely see kind of improvements made to it over time as people get more familiar with using kind of what that means and applying the taxonomy, and what tools do we do to do that, and what else needs to kind of be added in the next layers of the taxonomy that will come.
Peter, where are you positioning your funds?
Yeah, it's very similar. I echo what Nina has said. For us, it's Article 8 because we jumped over that bar. It feels like some time ago already, but it's for us. What is important is that investors understand it is just a general baseline, so to speak. It doesn't allow you to really judge how strongly ESG orientated a fund is. And the one thing that I think is a bit of a shame is that gap to Article 9 is quite big. And if you want to have a genuine Article 9 impact fund, that is at the moment quite specific, we feel. There's room for something in between, something that takes on especially those transition dimensions as well. I think that would be helpful. But in general, just as a comment, going back to where we are here and what we touched on earlier, to me, I think this is the beginning of an era of much greater transparency and quantification of what it means to reach your ESG targets. And I think it was never going to be perfect. It's been done by the EU after all, but I think it's a very good start altogether with those different components, and I think it will inspire new generations of this regulation going forward. And also, if we're zooming out of Europe, just like we've seen with GDPR, there is this tendency that those regulations actually impact other geographies as well.
Yeah.
And that is something we're already seeing today, where we're going with European investors into other parts of the world, and they want exactly the same.
And they're carrying along the terminology and the processes. Yeah. Bill, I'm going to ask a slightly different question, because I suspect that the type of answer will be pretty similar to Peter's and Nina's. But my question to you is, from an investor perspective, do you see SFDR starting to create a very clear barrier to entry, or Article 6 not being acceptable going forward? So their standard funds not being acceptable, so the funds for the investors that you deal with have to have some form of commitment and have to be willing to show and communicate that?
Yeah, I think that's potentially part of how investors will interpret this. But I think the point I want to emphasise is that we've got the global economy transitioning to zero carbon. You've got assets in transition. Frankly, the regulatory regime is in transition too. So, the current SFDR regime is open to interpretation. I don't think that's totally nailed down, and there are issues that haven't been addressed. Embodied energy aspects, for example, and transition. But and I think for EVORA and all of us, the reality of this is that requirement for data measurement disclosure is going to be changing for quite a few years, with the bar getting increasingly higher.
Yeah.
And I think that's good. I'm not necessarily complaining. I think regulation is helping with that, but it's going to change, and that's going to be right. That'll be quite painful. There'll be heartburn. There'll be indigestion of all sorts, right? And I just think that's the world we're in. Makes our job harder for a while. I can imagine a time in the future where the regulation settles, if we really make progress, as we may do over the next 6, 8, 10 years, 15 years. It may be that the regulation settles, but it's going to be in transition for a while. And the reason I say that is it's quite hard for investors to really know what they're getting into with a Article 6, 8 or 9. And I don't think it's probably fair to say that everyone here will see 6, 8 or 9 in exactly the same way, because it's been there a short time, and I think interpretation is part of what's going on here. Whether or not the UK sustainable direct regulation is the same or a bit different, I'm not entirely sure, but we'll find out soon enough. So look, that's a note of realism. We need to expect the bar to get higher and higher. People may be snooty about 6 now, but I would say 8 is going to be very passé 3 years from now. Yeah,
absolutely. And I think I want to move away from regulation now, because we talked a lot about regulation, but there's in real estate in particular, there's almost a longer history of voluntary disclosure and voluntary participation. So we have GRESB, PRI, and other schemes out there. So from the panel, where do you see, and whoever wants to go first is great, where do you see voluntary reporting and disclosure? Is it important? Will regulation replace it? Does it need to continue? And how, as real estate organisations, do you work your way through the myriad of different reporting schemes? How do you pick what's important? There's lots of questions there.
Emily's waving.
Emily, hi. Thank you.
I'd be happy to take a first pass and then hand it over to my colleagues on the panel. So we think they're important, and I'll sort of chin hat a little bit and talk about how, as a corporation, we engage with those. And we do think it's important to be a leader and actually a role model in ESG and climate risk disclosures. So Moody's Corporation provides disclosures under all of the frameworks all mapped together, but TCFD, GRI, PRI, CDP, you name it, right? Around, what's our net zero commitment, how we're dealing with risk in our real estate portfolio, our offices, in terms of transition risk, detailed physical risk assessments. You would think that would be the least we could do. We're a founding member of the Net Zero Financial Service Provider Alliance as part of the Glasgow Financial Alliance on Net Zero. So that means we're committed to integrating net zero considerations in all our products where relevant and material. And so I think the consolidation that we're seeing, I'm sure you've heard the recent announcement that CDP, CDSB, SASB, and IR, sorry for the letter soup, you don't need to know those acronyms because they're going away, merging into one board that will be under the umbrella of the IFRS, so accounting standards. That's a game changer. You're not going to have to deal with 25 standards going forward. You're going to have to report in a way that's really aligned. And then just a little curveball into this positive landscape evolution, and also tying to the SFDR conversation earlier, we need to be ready for the US to continue to blaze its own path and so not necessarily follow those recommendations. We know that the regulatory requirements from the SEC that are coming forth in early 22, they may or may not be aligned to TCFD recommendations. They're certainly not going to be aligned to SFDR. And so for global investors, for those of us who navigate in between those different markets, there's going to be some challenges in dealing with the difference in expectations, how quickly the markets are moving, and how far the regulators go. The EU obviously has gone a lot further in its specification. I wouldn't expect US institutions to be quite as prescriptive. We know that other countries like Japan, for example, tends to have yet a different approach and maybe a little more hands-off, but working on expectation a little more. So we're not yet at a fully standardization globally, but it's certainly starting to look better.
Okay, thank you, Emily. So from a voluntary reporting, let's drill it down to GRESB. So in real estate, we have to do, and I know a lot of the panel members have to participate in GRESB, or all of you do. Has it been a force for good? It's a challenging question.
I'm going to answer that question. I'm going to answer the previous question
Thank
with
you.
it as well.
Yeah.
So on reporting, I think it's interesting to observe the trends that we're seeing, which will actually also come on to this GRESB point. So I guess the trends that we've been seeing in terms of investor expectation around reporting, you know, we for many, many years published a M&G RE sustainability report. I think increasingly we're kind of not publishing that anymore in favour of publishing fund by fund, you know, full sustainability reports for the fund. And that is a trend now, that the level of information that our investors expect about what we're doing on a fund specific basis has just completely transformed over the past couple of years. But the other interesting trend that we've started to see is the investors not just wanting that report, the summary, but increasingly asking us for the underlying data so they can run their own modelling of transition risk and their own modelling of physical risk initially, and, you know, asking for energy data, carbon data. And so actually I think that, you know, the data transparency trend is only going to get more accelerated, that actually investors don't just want the summary piece, they want to, particularly the larger investors, want to do their own analysis. So I think that is the trend that we're definitely seeing and is set to stay and only get more sophisticated. Particularly, you know, we're going to see that on taxonomy alignment, we'll see it on any number of indicators that they start to ask for. So going back to the GRESB question, has GRESB been a force for good? Yes. And if you think about why GRESB was sort of started in the first place, it was to stop the duplication of effort that we were all facing, kind of one investor asking their survey on one thing, another investor asking their survey. The idea was that you could use GRESB as a single conduit. So I think it's been an amazing force around transparency, data collection. When you compare real estate to other private asset classes, you've probably got more knowledge, but I would say real estate has really upped its game, probably GRESB being a massive driver behind that. Has GRESB moved with what the investor expectation is, net zero carbon, actually looking at the performance of assets? I think it probably the 18-month consultation that it's now in at the moment reflects that GRESB recognises that it needs to go through quite a radical transformation, as we're kind of all doing, to really stay fit for purpose. So I think it has been good, but we need to see a massive transition in what it's doing. Otherwise, because what we're seeing again is a proliferation from our investors of different questions at the moment, asking for data. They're not using GRESB as the source of that because it's not doing as much as they need.
And Bill, that goes back to your point about change and about the industry as a whole needs to change, and we need to reflect this. And there are going to be painful points along the way.
Yeah, and there's a lot, you know, you mentioned the word transition again on GRESB. You know, Nina and I have talked about proliferation of aspects of this over more than a decade. One of the aspects I think is probably worth pointing out, for government-imposed regulation, everyone has to do it. It's there. You might not like it, and it may be clumsy, but it's there. Yeah. One of the issues about voluntary is you can end up with lots of nearly similar competing regimes, and the amount of people that are nearly duplicating things but not quite, and time wasted does detract from doing the purposeful things that really make a difference. And we all want to get to ultimately global, to Emily's point, ultimately global comparisons where an investor relatively simply can see the difference between all the things that we're doing and can make judgments about that. So you want to get to global standardization that is relevant and purposeful, and that's the goal. Yeah. I'm afraid it's going to be quite painful to get there.
Yes, I absolutely agree. because I'm going to stop the GRESB discussion there and the benchmark, and I want to go around the panel before we open up to Q&A, and invite each participant to comment on what are the key headlines, what are the key things that we need to change as an industry to drive progression. Peter.
Well, it's been much talked about, but one of the things I think is transparency, in the sense that there need to be the forums where we get together and very openly talk about the challenges, because the problems are so universal and so complex that joint solutions and collaboration are really critical. And my worry on that front is that, just as for the voluntary disclosure regimes, we have this plethora of new initiatives and organizations that are forming, and you need to hire a whole team of people just to be represented in those. And I think there's a real risk that we're not using the power of some of the existing industry organizations to drive that change and to lobby as well with the governments around the world. I think that is one big point, and then the other one has been mentioned before, but I think the whole upskilling that's required, and the investment that means in terms of people skills, but also data, in my perception, is still being quite grossly underestimated.
Okay, thank you. Emma?
I would agree with those points. I mean, I think for us, we see, I guess, the challenges as big opportunities for us in order to invest and to incentivize performance improvements. And I think that's back to the challenges of GRESB, which I know we're trying to move away from. But at the moment, all of the sort of voluntary disclosures are all around sort of governance, and they're around sort of data collection. And I think we just really, as an industry, need to move beyond that. And I think we need to move towards outcomes. And I think sort of other sort of reporting standards like the PRI, that's what they've tried to do. And there's been some challenges, obviously, in their latest reporting. But it's all been much more focused on sort of sustainability outcomes. And I think that's where we need to really be reporting against. I had a statistic, and I'm not sure whether it's changed, but about 3% of GRESB scoring is actually related to performance improvement. So I think, we have lots of funds where the whole purpose of the funds is to improve the sustainability of the building, but we don't get any credit in GRESB for that. So it is challenging.
Thank you. Bill, what would you like to change?
Yeah, I think I'm, even today, feeling that the industry we're in is pretty fragmented. Mm-hmm. So I think anything that can be done to get the industry to work together, and frankly, it's in all of our interest to work together on this subject. I'd echo some of the things that have been said about standardisation, avoiding proliferation, but frankly, working together to get to where we need to get to quicker rather than the long way around. And so events like this are important, the reason I know Nina is because we've talked about this for a decade or so, but long may that continue, and I think EVORA have got a role to play, for example, in bringing us together, having the right dialogue.
Thank you. Nina?
Echo everything that's been said. Collaboration, I think much greater collaboration, and using that collaboration to influence policy. There's a lot of stuff happening, and I think that as an industry, if we collaborated to get, meaningful indicators and then lobbied for those to be put into the regulation, we could have a much better chance at accelerating this. So I think we need to get much better at that. Asset level tools to try and cut through some of the complexity at the moment. We still don't really have the tools to make this simple for asset managers, investment managers to understand decisions, and I think that would really help with embedding it very quickly if we could have a bit of simplification.
Thank you. And Emily?
Oh, here I am. Sorry. So I'm going to, data transparency, absolutely critical, rigor and standardization to enable comparability. So this drives the kind of work that we do, right? Where we're going to try to help the market get there or provide the comparability where we can. Collaboration, of course, I'm going to throw one more in there, and that's accountability. What happens if companies don't deliver on their commitments? Is there a financial penalty? Is there a higher cost of capital? Is there a decrease in their credit ratings? We're not necessarily seeing that yet at scale systematically. I think it's just here and there a little bit, and that's going to be key to make sure that all of this gets us to having actual impacts and outcomes.
Okay, fantastic. Thank you very much. I'd now like to open the floor to questions. So if anyone's got any question, if you put your hands up, that'd be great. Emily.
Hi, thanks everyone. That was a really interesting discussion and hearing all of your thoughts. I guess my question is around one of the big topics they're discussing at the moment, the just transition. And what do you think commercial real estate's role is in that to ensure that all of these potential stranded assets, what are we going to do with them? And what's commercial real estate going to do?
Would anyone like to say that?
I think there's one simple answer, I think, is they'll see a big cut in their value. And then suddenly you'll be in a position to make them fit again, and they won't be stranded. But I think that moment of reckoning will come. The question is who bears that value decline.
Anyone else?
Go on. So one thing I would say, alongside the long time frame I think about, I also think we need to all be, in the context of transition to net zero, much more tuned in to the fact that the built environment is there for all of society and all of its uses. And it may be that a lower value obsolete office has got a use to society, just not as an office. And I think some creativity about this and some recognition that we're part of humankind, society in a more fundamental sense, I think is part of the equation. As an organisation, it's a long time ago where we used to invest in retail, offices, industrial. Now we're all parts of this, of the social and economic infrastructure investment environment, including social housing, for example. And I think that's an issue that our industry needs to get its arms around more.
Thank you. Any further questions?
I was going to jump in quickly, if I may.
Yes, yeah, please.
On the topic of just transition, and we like to think of just transition broadly, thinking also about physical impacts and what happens when the physical risk is priced in for properties that are at high risk. And I keep going back to the US. I'm sure there's similar issues in the UK, but you have a large part of the market with typically low-income households where the risk is not priced in. Those mortgages are held by the federal government. And when the government really starts pricing it in, it's a massive systematic impact. So it's not a gradual, it's really that Minsky moment. And so what that takes me to is the role of government in supporting that transition so that those assets, either from a transition or from a physical risk standpoint, so that we don't crash the markets and we don't create a huge income effect on lower income households, but rather think about how we do this transition in a way that allows markets to price in risk in a way that they're not yet doing at scale, but also protects the most vulnerable. So that's a really important question. No magic bullet here, but I do think that government will have to play an important role here.
Thank you. We'll take one more question from the floor.
Thank you. Barry Chambers is my name. I've travelled here with colleagues from Dublin, from KSN Horizon this morning, and thanks for having us, Chris and colleagues. It's a general question really to the panel. I'm just curious, they're all clearly well down the road on the ESG agenda and very developed plans and policies. What pitfalls or advice would you give to funds or real estate owners starting out on the journey or just recently starting the journey? Lessons learned along the way, perhaps, that might be helpful in the whole collaboration theme.
Can I make one observation? I wish I wasn't responsible for a big portfolio of assets that was created in a bygone era. So for those that are starting out, you have no legacy. You've got no decisions made in a past that is feeling less relevant. I'm not whining, but I think the new arrivals and the emerging companies have got an exciting opportunity, and that would be one observation. benefit if this is what you're talking about, make sure you capitalise upon the fact that you're not holding lots of legacy situations that by definition feel somewhat outdated by the events of recent years.
I think I'd go back to data as well, and the importance of, as if you're building a portfolio and building an ESG platform from an early stage, getting hold of information, get hold of energy, water, waste. It sounds so simple, but it's an enabling. Data enables action, and so that for me is really important.
Thank you. Maybe one more quick answer from me on this topic is. Start iteratively. Don't try to do everything the first time ago. Start simple. Try to identify what are the things that are really material, really meaningful for you, and then drill down on those. Because if you try to do everything, all the details, all the assets all at once, that can be quite overwhelming. So that would be the advice: is start small and make sure you walk before you run.
Okay, thank you. I think we had one more question in the room.
I had a couple of questions, but I think I'm just going to end on a comment, and it's a request. So I'm at JLL, I'm an investment broker at JLL. It's a request for the market leaders out there. I think when you've got a process where even though it's not the main decision that you've turned it down, the more you can feed that back to brokers and sell-side agents, you're really helping me and you're helping move the market, because we can keep saying we can upskill, we can train our brokers and agents, but the minute a client says, and it's starting to happen, what's the CRREM pathway? Is the asset EU taxonomy aligned? They come running to me, or I'm on the call, and they start training themselves. And that is really what's driving the market. And the more and more questions that get asked, the more liquidity is affected, the more we'll see a price discount. I know I shouldn't be promoting that, but I think it really will move the market. So please just don't be afraid to assume that brokers don't know what they're talking about on ESG. Ask the question and put them on the spot, and it will really make a difference.
Can I make a comment, please. But reflecting the two questions there? Do you think? And you mentioned data a lot. I know you would say that, and so would Emily. Do you think there's such a thing emerging as a transparency and quality of data premium? Do you think, because that from a broker point of view or from a buyer point of view, the more high quality data you've got, the more certain you can be. In theory, that's an element of de-risking. Or opacity deserves a discount. I mean, do you think that's a thing?
I do think it will emerge. I think there'll be a focus especially on acquisition and due diligence. I think there will be an increased focus on the accuracy of the estimate of the calculations that are put forward. So if you look at going into the weeds a little bit, putting some detail into this, identifying net zero carbon reduction pathways involves working out cost benefits based on energy data and performance data. And if the information is not available, they're estimates, and there will be increasingly all we need are in the market one or two pretty catastrophic estimates to be wrong. And someone will have acquired an asset that they thought was ready for net zero, that they thought was helping their portfolio to get down to net zero, but that could be miles off. So there may be a few corrections and adjustments that of those sorts of issues that really drive the focus on the accuracy and the premium of having quality data in the decision-making process. And that goes for, from my perspective, from both equity, real estate, and also lending. Nina?
I think just to follow on that point, around the collaboration point. So, at the moment, if we're looking at doing CRREM analysis during the acquisition phase, if we use one provider, they're doing their own estimates of what they think they should use for an office if we don't have data, and another provider will do another. And there will be a bit of pressure on those consultants to probably make those assumptions favourable, perhaps, so that deals can go through. But if the market was perhaps to agree to use really penalising factors, where, common market estimation factors, that's one fairly quick way in which you could adjust the market by essentially penalising by not having data, by being using not very favourable estimates.
That would make people get data very, very quickly.
Yes.
Yeah, absolutely. Yes.
Can I just make a couple of final comments? Thanks. Really interesting comments from the panel. I think on is there arbitrage of data? I absolutely believe there is, and I think we need to move, exactly as Nina's saying, almost to an ESG passport. So on disposal, if that data is not there, inhibits that transaction or it creates a discount. I think the challenge is consistency and having a common standard. And I truly believe that if we try and do it ourselves voluntarily, it won't work. I think it has to go through regulation. And also, if we do it voluntarily, it will only be that the long tail won't get picked up, not in the same speed. Just as you talked about that transaction where a bigger investor was willing to work out the associated discount, whereas others weren't, and they lost the deal. Now, as Bill says, there's going to be winners and losers, and they may well lose out on that. When it comes to, they'll hold it for a certain period. When it comes to the next sale, they may find out that they're in a difficult position. But what I want to just put to everyone in the room who's in this industry, not just to the panel, is what are we going to do as an industry to lobby regulation that provides the right benchmarks and the right data that enables change? Because we know, although we've talked a bit about GRESB, and the investors have used GRESB to look at performance, and we're saying that isn't adequate anymore. And we can try and lobby GRESB as an example to make that change, but it doesn't cover the whole industry. Only regulation can do that. So surely we've got to find a route to say what frameworks and performance metrics are required that we know are necessary. If we don't know, no one does, and then we can lobby the government associately to achieve this. I just want to really put that out to the floor to say, I think the onus is on us. How are we going to collaborate to enable that to happen?
I think we're all in agreement, Chris. I think I'm going to draw it to a close. We've run over slightly, and I don't want to last any longer. I think the key messages that I've scribbled down are, when we talked about, where are we with COP and what do people view, that there's optimism, but also a degree of worry and cynicism, if I can put it that way. So there's a balance there. Optimism that the language is right, the setting of objectives and programs are needed. That's what we need. But we need to move things forward, and we need to progress with action. And to progress with action, the real estate market needs to change. That change will be, in some cases, painful. It won't be straightforward. And, two key words, collaboration and accountability. So Emily highlighted the need for accountability. But to really drive that change, everyone in this room, everyone on the call, that those working in the real estate industry, we need to collaborate to drive the ESG agenda forward. So I'm going to finish with that. And final remarks, thank you very much to the panellists. Thank you, Emily, for being on Zoom and waving when you wanted attention. That was fantastic. And thank you for everyone who's joined both digitally and also in the room today. So a round of applause. Thank you.